Hey future investors, welcome back to our channel. Today, we're diving into the wisdom of one of the greatest investors of all time, Warren Buffett. Known as the Oracle of Omaha, Buffett has shared countless pieces of advice over his legendary career. In this video, we'll explore the 20 most famous quotes from Warren Buffett on investing, break them down, and provide real-life examples to help you understand and apply his insights. Let's get started. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett emphasizes the importance of capital preservation. The idea is that avoiding significant losses is crucial because recovering from them can be extremely challenging. This isn't just about being cautious, but about making smart, informed decisions. If you lose a substantial portion of your capital, the amount of effort and time needed to recuperate that loss is much greater than the initial loss itself. Imagine you have $100,000 and you lose 50%, leaving you with $50,000. To get back to $100,000, you need a 100% gain. Price is what you pay, value is what you get. Buffett distinguishes between price and intrinsic value. Price is the market value, while intrinsic value is what a stock is truly worth based on its fundamentals. Understanding this difference is key to value investing, which involves buying stocks that are undervalued by the market at each given time. For instance, during the dot-com bubble, many tech stocks were priced exorbitantly high, but Buffett avoided them because their intrinsic value did not justify the high prices. So, you should learn how to calculate the intrinsic value of your favorite stocks. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett prefers quality over bargain hunting. A wonderful company will continue to perform well over time, providing consistent returns and stability, whereas a fair company might struggle even if bought at a lower price. Our favorite holding period is forever. Buffett advocates for long-term investments. He believes in buying and holding quality companies indefinitely, benefiting from their long-term growth and avoiding the costs and potential mistakes associated with frequent trading. This approach aligns with the principle of compounding, where reinvested earnings generate additional earnings over time. Buffett has held stocks like Coca-Cola for decades, benefiting from consistent growth and dividends. The stock market is designed to transfer money from the active to the patient. Patience is a virtue in investing. Those who trade frequently often lose to those who invest for the long term. For example, an investor who bought Amazon stock in its early days and held onto it has seen immense returns, while frequent traders might have missed out on the long-term growth due to short-term fluctuations and transaction costs. Risk comes from not knowing what you're doing. Knowledge and understanding reduce risk. Investing blindly or based on tips without thorough research is risky. Educated investors who understand the companies they invest in can make more informed decisions and manage their portfolios more effectively. For instance, Buffett thoroughly researches each potential investment, looking into the company's earnings history, competitive advantages, and future prospects before making a decision. Be fearful when others are greedy and greedy when others are fearful. Buffett advises contrarian investing. This means buying when the market is down and everyone else is selling, and selling when the market is up and everyone else is buying. This strategy takes advantage of market overreactions and mispricings. If you don't find a way to make money while you sleep, you will work until you die. Passive income is crucial for financial independence. Investments should generate income without active involvement, allowing you to earn money even while you're not actively working. This can come from dividends, interest, or rental income. Dividend stocks, rental properties, and other income-generating assets allow you to earn while focusing on other pursuits. For example, Buffett's investments in companies that pay consistent dividends provide him with a steady stream of passive income, contributing to his wealth, even when he isn't actively trading. In the business world, the rearview mirror is always clearer than the windshield. It's easier to understand past events than predict the future. Learning from historical events is valuable, but predicting future market movements is inherently uncertain. The best investment you can make is in yourself. Education and personal development yield the highest returns. Continuous learning helps investors stay informed and adapt to changing market conditions. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Invest in companies you believe in long-term, regardless of market fluctuations. This mindset ensures that you are investing in quality businesses that can withstand market downturns and continue to perform well over time. Buying stocks in a solid company like Microsoft, which has strong fundamentals and growth potential, means you're confident even if the market closes temporarily. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Buffett argues that knowledgeable investors don't need extensive diversification. They can focus on a few well-understood investments. Over-diversification can dilute potential returns, while a concentrated portfolio of well-researched stocks can yield higher returns. Instead of owning 50 different stocks, Buffett might hold a concentrated portfolio of a few high-quality companies he understands deeply. The most important quality for an investor is temperament, not intellect. Emotional discipline is key. Investors must remain calm and rational, especially during market volatility. A sound temperament helps investors avoid impulsive decisions based on fear or greed, which can lead to significant losses. For instance, during the 2008 financial crisis, many investors panicked and sold their stocks at a loss, while Buffett remained calm and even increased his investments, resulting in substantial gains as the market recovered. Someone's sitting in the shade today because someone planted a tree a long time ago. Long-term investments pay off. Actions taken today can provide significant benefits in the future. This quote highlights the importance of patience and foresight in investing. Investing in a retirement fund early in your career ensures a comfortable retirement later. Wall Street is the only place that people ride to in a Rolls-Royce to get advice from those who take the subway. High net worth doesn't equate to better investment advice. Even modest investors can have valuable insights. An average person who diligently studies the market may offer better advice than a wealthy individual who invests based on trends or hearsay. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. This advice, similar to an earlier quote, emphasizes contrarian investing. Profits often come from going against the crowd and making decisions based on careful analysis rather than market sentiment. Buying undervalued stocks during a market panic can lead to substantial gains when the market recovers. Time is the friend of the wonderful company and the enemy of the mediocre. Quality companies grow stronger over time while mediocre ones deteriorate. Investing in strong businesses allows time to work in your favor, as these companies will likely continue to innovate, grow, and increase their market share. Investing in Amazon early on would have yielded massive returns. Never invest in a business you cannot understand. Invest within your circle of competence. Understanding a business reduces risks and increases the likelihood of making informed decisions. If you don't understand biotechnology, it's better to invest in sectors you are familiar with, like consumer goods or tech. You can't produce a baby in 1 month by getting 9 women pregnant. Some things take time and cannot be rushed. Investments need time to mature and deliver returns. Expecting quick returns from a long-term investment strategy is unrealistic. Patience is essential. The difference between successful people and really successful people is that really successful people say no to almost everything. Saying no to most opportunities allows you to concentrate on the best ones. Buffett often passes on many investment opportunities to focus on the few that he thoroughly understands and believes in. And there you have it. Warren Buffett's top 20 investing quotes, complete with expanded explanations and examples. By understanding and applying these principles, you can make more informed and strategic investment decisions. If you enjoyed this video, be sure to give it a thumbs up, subscribe for more investing tips, and hit the bell icon to get notified of our latest content. Thanks for watching, and I'll see you back in a great future.